The preparation of group consolidated external reports is a fundamental area of IFRS accounting standards because many modern organizations operate through groups of companies rather than as single entities. A group exists when a parent company controls one or more subsidiaries. Consolidated financial statements are prepared to present the financial position, performance, and cash flows of the parent and its subsidiaries as if they were a single economic entity. The purpose of consolidation is to provide users with a complete and transparent view of the group's overall financial activities rather than separate legal entities operating independently. Consolidated reporting improves comparability, prevents double counting of intragroup transactions, and supports informed decision-making by investors, regulators, lenders, and other stakeholders within international financial reporting environments. A subsidiary is defined under IFRS accounting standards as an entity controlled by another entity known as the parent. Control exists when the parent has power over the investee, exposure or rights to variable returns from involvement with the investee, and the ability to use its power to affect those returns. Control may arise through majority voting rights, contractual arrangements, or other mechanisms providing decision-making authority. Determining whether control exists requires careful assessment of economic substance rather than merely legal ownership percentages. Once control is established, the subsidiary must generally be consolidated into the parent's financial statements. Correct identification of subsidiaries is essential because consolidation significantly affects reported assets, liabilities, revenues, expenses, and overall financial performance presented to stakeholders. Preparation of a consolidated statement of financial position involves combining the assets, liabilities, and equity of the parent and subsidiaries line by line while eliminating intragroup balances and transactions. During consolidation, the parent's investment in the subsidiary is eliminated against the subsidiary's equity existing at acquisition date. Any excess of consideration transferred over the fair value of identifiable net assets acquired is recognized as goodwill. Pre-acquisition profits belong to the group structure at acquisition and form part of net assets acquired, while post-acquisition profits contribute to group retained earnings. Non-controlling interests represent the portion of subsidiary equity attributable to shareholders outside the group. Proper treatment of goodwill, pre- and post-acquisition reserves, and non-controlling interests ensures accurate representation of group financial position within consolidated statements. Uniform accounting policies and coterminous reporting dates are necessary to ensure consistency and comparability in consolidated financial statements. Subsidiaries within a group may operate in different jurisdictions or industries and may initially prepare financial statements using different accounting policies or reporting dates. IFRS accounting standards require adjustments to align accounting policies across the group so that similar transactions and events are accounted for consistently. Similarly, subsidiaries should ideally have the same reporting date as the parent. Where reporting dates differ, adjustments must be made for significant transactions occurring between reporting periods. These requirements ensure that consolidated financial statements reflect a coherent and reliable representation of the group's financial performance and position as a unified economic entity. The preparation of consolidated statements of profit or loss, other comprehensive income, and changes in equity requires combining income, expenses, gains, losses, and equity movements of group entities while eliminating intragroup effects. Revenue and expenses arising from transactions between group companies are removed to prevent overstatement of group performance. Post-acquisition profits are allocated between the parent and non-controlling interests according to ownership percentages. When subsidiaries are acquired or disposed of during the reporting period, consolidation includes only the period during which control existed. Disposal of an entire interest requires recognition of gains or losses on disposal and a recognition of subsidiary assets, liabilities, goodwill, and non-controlling interests. These adjustments ensure that consolidated performance reflects only external transactions and accurately represents changes in group ownership structures. Overall, preparation of group consolidated external reports provides stakeholders with a comprehensive view of the financial activities, resources, obligations, and performance of corporate groups operating as unified economic entities. Consolidation principles involving control assessment, subsidiary identification, goodwill recognition, non-controlling interests, and elimination of intragroup transactions ensure that financial statements faithfully represent economic reality rather than separate legal structures. The use of uniform accounting policies and aligned reporting periods further enhances comparability and consistency within group reporting. For DIP IFR candidates, Understanding consolidation is essential because group structures dominate modern international business environments, and consolidated financial statements are among the most significant and technically demanding areas of IFRS accounting standards and professional accounting practice.